Welcome back in. It's time to talk about your money here at Money Tuesday. And when it comes to investing, in most cases, if you want a big reward, you got to take some big risks. Might not be the right time for you to try to take that risk, though. We have senior advisor with the Wells Group, Marshall Clay, joining us right now to get some advice on that. Marshall, good to see you this morning.
Morning, Mike. How are you?
Doing well. I appreciate you joining us here this morning. And right now, we know there's been a lot of volatility in the market, even though the market has rebounded quite a bit now.
Yeah, you're right. I mean, we have come a long way off the March 23rd lows, and I think it's important now that we're back close to all-time highs for all of your viewers to really review where they are in terms of how much risk they're taking. The last thing you want to see is as we enter into an election season, there's still a lot of uncertainty out there. You certainly don't want to be taking unnecessary risk, particularly if you're close to needing money from your portfolio.
Well, and a viewer actually sent us a question about this, a little bit older in age, in his early 60s, looking at retirement very soon, and lost a lot of money, obviously, with the downturns, getting some of it back. So let's talk about that. Short-term needs, 1 to 3 years. I need money. What should I do?
Yeah, so we really view any sort of cash flow need that you need in that time frame as uninvestable. I mean, you really need to have that cash in checking accounts, savings accounts, CDs, things that are going to absolutely preserve your principal. Now, if you're talking about more near term, maybe call it 3 to 7 years, okay, you may be take a little bit more risk, but anything in that short-term time frame, you really need to wrap your arms around that money.
All right, specifically if I'm in the 3 to 7 year range, what should I be putting my money towards?
Well, I mean, there may be some opportunities to invest in some stocks here and there, but I still wouldn't get too far out on the risk spectrum. I would still be looking at pretty safe and secure things. Maybe some more, bond-like instruments that offer a little bit more upside potential, but also give you some of that preservation of capital attributes.
All right, and then for a lot of folks, they're in the long term. So let's say 7 years and beyond.
Yeah, so I mean, to address your viewer who's on the cusp of retirement, I think one of the goals that we try to set for clients is to at least have 10 years of your expected cash flow needs. So for example, if you need $5,000 a month from your portfolio, that's $60,000 a year. You need approximately $600,000 of money just set aside in the bond portion of your portfolio.
Okay.
Obviously, you want to be taking some risk on the stock side as well to counteract the negative effects of inflation, but you want to have enough money to where when we get into these storms like coronavirus or a 2008, 2009, generational bear market, that you have enough money set aside where where your cash flow is coming from for an extended period of time.
All right, some perspective there to look for as you move forward there in some of your investing, your 401k and whatnot. All right, Marshall Clay with the Wells Group. Thank you so much, sir.